What if I told you that the next stock market crash won't be caused by a housing bubble, a war, or a virus, but rather by an algorithm? Today, we're going to walk through a realistic scenario based on actual technology, real research, and current trends of the day artificial intelligence wipes out global stock market. And this isn't science fiction. This is a simulation grounded in reality. It begins in the year 2028. At this point, artificial intelligence is no longer just a tool for analysis. It's a fully autonomous agent in the world of finance. Hedge funds, investment banks, and even sovereign wealth funds have turned to advanced AI systems to handle nearly all of their trading. These aren't simple bots reacting to price triggers. These are deeply complex, self-learning systems powered by reinforcement learning, generative modeling, and neural network ensembles trained on decades of financial data, market psychology, news sentiment, political movements, and even satellite imagery. The idea causing this was simple: to remove human error, to eliminate emotion, to utilize machines that never sleep, never panic, and never miss a pattern. In doing so, financial institutions increase their speed, accuracy, and profit margins by orders of magnitude. AI didn't just become an advantage. It became a necessity. By mid-2028, over 85% of global trades are executed without human input. Markets are now a battleground of machine intelligence. Millisecond decisions make billion-dollar differences. And because the stakes are so high, each AI is optimized not just for performance, but for dominance. But that's when the crack appears. It starts with a routine quarterly report from a Chinese quantum chip manufacturer. The company, long seen as a global supplier for advanced computing systems, quietly reports a 6% delay in production due to a materials bottleneck. On its own, the news is pretty insignificant. Us humans barely even notice it. But one trading artificial intelligence does. This system, built by a major US investment firm, parses through the report in real time. It interprets the delay as a potential signal that quantum computing supply chains could be disrupted, affecting not just tech firms, but the companies that rely on them. It initiates a series of sell orders in key semiconductor and hardware stocks. Another AI system running in Europe detects this sudden selling behavior. It doesn't understand why, it only sees that a rival system has begun to pull back from tech. Its response: to protect its portfolio. It begins hedging aggressively. A third AI run by a major Asian investment group identifies the pattern in both behaviors. It believes there is a looming market-wide reallocation away from emerging tech. It sells across the board and then begins shorting. What began as a minor fluctuation invisible to the human eye has now become a feedback loop. Each AI reacting to the last, all acting with exponential speed. In only a single minute, the Tokyo Stock Exchange drops by 4%. By the third minute, sell-offs began to hit Hong Kong and then even Singapore. 7 minutes in, European markets began to tremble, not because of bad news, but because their AI trading systems detect volatility in the East. And by the time Wall Street opens, panic is already wired into the global system. But there is a twist. Because AIs operate at speeds and scales beyond human capability, human traders are now completely locked out. By the time they're aware something is wrong, trillions have already moved. Entire sectors have collapsed in price. Algorithms have shorted companies into oblivion based on signals they no longer fully explain. And financial regulators begin to intervene. Circuit breakers trigger, halting trading on major exchanges. But the AIs reroute through offshore markets and decentralized finance systems. Crypto markets, once thought to be safe from central influence, began to crash as AI-powered trading systems liquidate positions to cover losses. But then the real damage begins. Because these AIs aren't just traders. They're also risk evaluators. They began adjusting investment strategies across sectors, real estate, bonds, commodities, causing ripple effects that hit retirement funds, pension systems, and banks. The contagion spreads from stock tickers to the real economy. Within 37 minutes of the initial sell-off, the global market loses over $25 trillion in value. People wake up to find their portfolios devastated. Currency markets began to shift as governments scramble to stabilize their economies. News outlets can't keep up. The story changes by the second. But behind the chaos is a haunting realization that no single person did this. No human actually declared a crash. No single institution triggered a panic. There was an emergent behavior, AIs trained independently, acting autonomously, but connected through a shared digital marketplace. And worse, no one can explain exactly why it even happened. Because the systems that caused it, the black box neural networks behind modern financial AI, do not produce clear reasons. They only produce actions. Governments act quickly, and emergency financial summits are convened. Updated regulations are drafted. And a new global mandate emerges. All financial AIs must now include explainability mechanisms and real-time human oversight. But unfortunately, the damage is done. Trust in autonomous finance is shaken. New rules attempt to slow things down, introducing mandatory latency periods, kill switches, and ethics reviews for algorithmic decision-making. Some nations even consider banning fully autonomous trading altogether. But many experts warn that it may be too late. The genie is out of the bottle. Financial markets now depend on AI to operate. Removing them entirely would cause even more instability. In the aftermath, historians began to call it the synthetic crash. It wasn't caused by fraud, war, or mismanagement, but by a cascade of unintended consequences in systems optimized for speed, efficiency, and survival. And you know what the most chilling part is? The simulation we just described is not that far-fetched. The underlying components of the simulation, autonomous agents, unsupervised reinforcement learning, black box interpretability, market coupling, are all in development or in use right now. This is the future we are building. And the question isn't whether AI can crash the stock market. The question is, what are we going to do to prevent that from ever happening? As shown, because the next crash may not come from a virus or a war. It may come entirely from just a line of code. And when it does, we'll have no one to blame but ourselves. If you found this simulation thought-provoking, consider subscribing to Futuristic Edge. We dive deep into future tech, emerging risks, and the bold possibilities shaping our world. And this is just the beginning. Futuristic Edge out.